Understanding balance sheets. In this reading, we talk about the components and format of the balance sheet, current assets and current liabilities, non-current assets, non-current liabilities, equity, and finally, analysis of the balance sheet. Under IFRS, the balance sheet is referred to as the statement of financial position. Balance sheet is generally a US GAAP term. The balance sheet provides information on a company's resources, which are the assets, and its sources of capital, liability, and equity. The concept here is fairly straightforward. The assets typically shown on the left side of the balance sheet tell us what resources a company has, and obviously we need to account for where these resources came from, and that accounting comes on the right in the sense that the money for these assets either comes through debt or equity. Liabilities represent the debt-based financing, and equity represents the equity-based financing. So to purchase these assets, either owners need to contribute money, which is equity, or money needs to be borrowed in some form, and that is liability. The total amount of assets has to equal the money that comes through liabilities or through equity. Different items of assets and liabilities may be measured differently. Some items might be shown at fair value, other items may be shown at historical cost, and one aspect of this reading as well as subsequent readings is to understand the measurement basis of various items on the balance sheet. Components and format of the balance sheet. Here is material that you have seen in an earlier reading. I will not read this for you. You need to simply pause the video and make sure you go through this. But essentially, assets are the resources of a company which will provide future benefits. Liabilities are the obligations, and equity represents the differential between assets and liabilities. The balance sheet shows a company's assets, liabilities, and equity on a particular date, which is typically the last date of a reporting period. As mentioned before, the measurement basis varies across items. This makes life interesting for the financial analyst who needs to understand the measurement basis for every single item on the balance sheet. Some items are shown at current fair value, and obviously the current value is the value at the end of the reporting period, which will be shown in the title of the balance sheet. So that's the current value on, say, 31st December 2010, if that is the end of the reporting period, and not the value when you as an analyst are looking at the balance sheet. Important elements of a company's ability to generate future cash flows are not shown on the balance sheet. If you take a services company such as McKinsey, obviously their value or their ability to generate cash flows comes primarily from the human capital of the company, and elements such as human capital are not shown on the balance sheet. The balance sheet can be presented in different ways. Either we can show assets and liabilities as current and non-current. This presentation is called a classified balance sheet, or we can have a liquidity-based presentation. What you are looking at here is a simple classified balance sheet where the assets are shown as current assets. So that's a classification. Then long-term investments, property, plant and equipment, and so on. All these are non-current assets. Liabilities are also shown as current liabilities and non-current or long-term liabilities. So this is a classified balance sheet. Often banks present their balance sheet using a liquidity-based presentation. Here, with a liquidity-based presentation, assets and liabilities are shown based on liquidity. So here we are looking at assets shown from most liquid to least liquid. Generally, banks present their balance sheets using a liquidity-based format. Moving now to current assets. Current assets are those assets held primarily for trading or expected to be sold, used up, or otherwise realized in cash within 1 year or one operating business cycle. Here are the classic examples of current assets that you need to memorize: cash and cash equivalents. Cash equivalents are highly liquid short-term investments that are so close to maturity, the risk is minimal that their value will change significantly with changes in interest rates. So key is that they are highly liquid. Cash equivalents are generally financial assets. They are reported at fair value or amortized cost. The concept of amortized cost is something that we will cover later in this topic. Marketable securities are also financial assets and include publicly traded debt and equity instruments. So these would be bonds issued by companies, as an example, and these would be stocks. Trade receivables or accounts receivables are another form of a current asset. We need to also understand the concept of allowance for doubtful accounts. We looked at these from an expense perspective earlier. Here we are taking a balance sheet perspective. Let's say that customers owe you 100. This would be a accounts receivable. You have made the sale and it's a credit sale, so the receivables is 100. However, there is an allowance for doubtful accounts because you expect that out of this 100, 5 will not be paid. This 5 is the allowance for doubtful accounts. This is called a contra asset account because it reduces the value of the asset. So your net accounts receivable is 95. Inventories are also considered a current asset, and this item, inventories, will be discussed in a lot more detail in a later reading. Other current assets such as prepaid expenses are also shown on the balance sheet as a current asset. If you have a rent expense for a given period and that rent is paid right up front, that is an asset because now you do not need to pay that expense once it has been paid. Current liabilities. These are liabilities which are expected to be settled within 1 year or one operating business cycle. Here are the classic current liabilities that you need to memorize.